A los empresarios por esa visión para el 2023. Los escuchamos muy atentamente sobre esas preocupaciones que tienen actualmente en torno a la inflación, a la subida de tasas de interés, subidas que presionan, por supuesto, a la inversión y los costos de financiación, las primeras señales de moderación en el consumo en Colombia, los mensajes también claves que envían en torno a las reformas que impulsa el actual gobierno de Gustavo Petro, reforma fiscal y reforma laboral. Y finalmente, ese aporte social que, por supuesto, hacen siempre los empresarios en nuestro país. Como denominamos nuestro libro para el próximo año, aquí estamos hablando de nuevos retos, pero también de nuevas oportunidades. Muy bien. A continuación, quiero invitarlos al último panel de esta gran jornada académica. Vamos a hablar de las expectativas sobre el dólar y las inversiones. Estaremos con Paola Figueroa, economista del Instituto de Finanzas Internacionales, y Jordan Jackson, estratega J.P. Morgan Asset Management. Va a estar moderando Germán Cristancho, que es nuestro gerente de investigaciones económicas y estrategia de Davivienda Corredores. Germán y Jordan van a estar hablando en inglés, pero para ustedes vamos a tener la traducción simultánea para que puedan disfrutar de nuestro siguiente panel. Bienvenidos.
Well, we got to the final part of the event. For this space, we will be talking about US dollar investment opportunities and the outlook for financial markets. So I will be talking to Jordan Jackson and Paola Figueroa. And I would like to welcome Jordan and Paola. I don't know if you can hear me.
Yes.
Yes. Thank you for having me.
Thank you very much for the invitation. I'm glad to be here.
Thank you for accepting our invitation. And well, US dollar has been in the center of this year and has proved its position or its reserve currency status this year, maybe accumulating an appreciation close to 18%. So actually, we saw the euro going below parity and other currencies depreciating a lot versus US dollar. So what do you think this is happening, and what is your outlook about or for the US dollar? I would like to start with Paola, maybe with your thoughts on the US dollar.
Thanks, Germán. Yeah, certainly there is significant talk about the U.S. strength. Indeed, the Federal Reserve has doubled down on its tough anti-inflation message, given persistently high core inflation. It has really left no doubt that it will run the risk of a hard landing if needed to bring down inflation, and the rates will remain higher for longer. So, of course, we have this going on in the background. However, and at IIF, we believe that the bulk of the unprecedented dollar strength has really come against the G10, while emerging markets have been more resilient. We see this more as a sign of euro weakness, probably also weakness in Japan, as the underlying driver of the dollar strength against the G10 is the energy price shock, which has caused a sharp deterioration in external balances across European countries. We were actually very early in forecasting a euro below parity. It has now fallen for 14% or so far this year, and we think that this move will continue. There are two reasons. Mainly, the Eurozone traditionally has been a large current account and trade surplus region. This picture has turned around. The Eurozone is now a large current account and trade balance is now showing a strong current account deficit. In the near term, the terms of trade shock from higher energy prices is affecting the external balances, but also, most importantly, the rising energy costs and how that cheap Russian energy source is now over. means higher costs for the manufacturing power, mainly Germany. This is going to imply lower profitability and less capacity to invest, and therefore more challenging medium-term picture. And then a second way we look at it is the euro fall is that markets are still pricing significant ECB hikes. This follows the signaling from the Fed, which has been quite hawkish in its recent statements. We expect the policy rate to reach 2% from the current 0.75% rate for the end of the year. And so the upcoming October meeting will having another 75 basis point hike, followed by 15 basis point hikes in the remainder of the year. And what we see is that the ECB needs a change in narrative. Inflation is high, but that's because Putin has launched this this war and this energy war, and not because the economy is overheating. We think that rate hikes are not going to dampen inflation, and they would only make the Eurozone recession deeper. So at some point later on, we expect these hikes to have to be reversed in the course of next year. And we do believe that the ECB, the tightening that the ECB is currently pursuing, in our view, is not justified, given that the Eurozone is slipping into a fairly deep recession.
Thank you, Paola. Jordan, Paola has a view from the euro weakness, but maybe we have seen the Japanese yen, the renminbi also losing space versus US dollar. What is your opinion about this question and the context of the US dollar from the J.P. Morgan Asset Management point of view?
Sure. Just to maybe follow up and reiterate some of the points that Paola made. The primary reasons, we think it's two reasons for the dollar strength: relative growth, with U.S. growth being holding up exceptionally a bit better than the rest of the world, and aggressive Federal Reserve action. And it's been quite remarkable. Coming into the year, the Federal Reserve was only expected to hike interest rates 4 times by 4 25 basis point increments this year. Now they're expected to hike rates by 17 25 basis point increments. So again, a massive shift in terms of Fed expectations. Conversely, when you look at places like China, the Bank of Japan, they're very much still in accommodative mode. So while the Federal Reserve is very hawkish and is committed to raising interest rates to kill inflation, the Bank of Japan and the Bank of China are actually easing. The Bank of Japan ramping up bond purchases in order to remain control of its yield curve control and keeping that 10-year JGB anchored below 25 basis points. You also have the People's Bank of China, who's dealing with consumer sentiment that continues to be very sour, a zero COVID tolerance policy, which looks very unsustainable, and an overly leveraged property sector, which is clearly impacting bank profitability and sort of tightening up lending standards across the banks there. And so they're actually cutting rates and trying to provide additional liquidity and stimulus in order to encourage a pickup in lending. And one of the metrics we like to watch is that credit impulse in China, and we're starting to see some earlier signs of that turning around. But it's very clear to us that the People's Bank of China may need to do a little bit more work in order to get their economy back on board. And so with the Fed continuing to raise rates, the Bank of Japan and the People's Bank of China easing policy, this very much suggests that, again, the dollar may remain fairly elevated.
Perfect. I also would like to have your view or your opinion about the emerging market currencies, but especially from the Latin American currencies. In Colombia, for example, we have seen the dollar going up to a all-time high level, close to 4,600 or 4,700, something like that. So, and also in Latin America, the political factor has impacted and has increased the currency volatility. Paola, you cover the region and some emerging markets. how do you see the Latin American currencies and the outlook? And I don't know if you could make some or share some thoughts on the Colombian peso.
Thanks. I heard the question in Spanish, but I'm going to continue in English.
Yeah, sure.
We see in emerging markets, and particularly in Latin America, a very mixed picture. In fact, what we see this year is that in the early months after Russia invaded Ukraine, Latin currencies rallied, led by Brazil as commodity prices boosted defensive trade. Since June, the U.S. upside surprise in inflation that caused the Fed to shift to 75 basis point hikes, coupled with fears of global recession, have hit everyone in emerging markets. On the other hand, we've had in Latin America extremely proactive hiking cycles. The main example is Brazil, where we've had more than 12,000 basis points in tightening since the end of 2020. We think that policy rates in Chile, Colombia, Mexico have not yet reached their peaks. And in general, it will be hard to see meaningful monetary easing in the region until the second half next year, and still high inflation. This makes the picture for LATAM currencies potentially better than it has been in some time. So we have recently updated our estimates of exchange and misalignments based on our FX fair value model, and we find large undervaluations. That is, we see appreciation, especially for Brazil and several Asian currencies. But we see substantial overvaluations. That means we see further depreciation for countries like Turkey, Argentina, Egypt, and India. Other LATAM currencies, including Mexico, Colombia, Chile, and Peru, are in the camp of overvaluation. So we see potential for further depreciation, but not alarmingly so. What is kind of behind the scenes, behind these trends for the LATAM currencies? So flows to local government bonds have been relatively uneven across emerging markets since COVID began. Colombia has done very well so far this year with important flows into local government bonds, but a few major emerging markets like Mexico and Indonesia have seen significant outflows. If we look at in terms of the overall macroeconomic outlook for the region, Mexico's trade deficit, for example, is really wide this year, and that kind of suggests the pitfalls of becoming an oil importer. But tourism and remittances have been strong enough to prevent wider imbalances. So we expect a current account deficit that is well below 2%. And this, together with a manageable fiscal deficit, is going to kind of attenuate the impact of what the weak flows, even though flow dynamics are still a sign of low confidence in Mexico. Now, Brazil is this year's top performing currency against the US dollar. The current account deficit in Brazil has widened a bit, but it remains very small relative to FDI inflows. As often in the past, fiscal policy and political risk of a broad deterioration of policies are the main risk. But in general, the recent election with Lula's narrower than expected margin of victory and the solid electoral performance of the ruling party and its allies in the legislative and gubernatorial election have triggered initially a very positive market reaction. So we think that the tight election outcome in Brazil should make actually pro-market reforms tougher to unwind, removing some downside risks in policies. Now, the tight election could also result in higher transition risk and gridlock in Congress, and this is going to make the short-term outlook more challenging, even though this is not our baseline case, and we see significant potential for appreciation of the real. So I would stop here.
Thank you, Paola. Jordan, you have any view on LATAM currencies, or maybe actually on Colombian peso?
Sorry, could you repeat the question?
Sure, Jordan. I don't know if you were listening to me very well, but do you have any thoughts on the LATAM currencies and maybe on the Colombian peso. You from J.P. Morgan, how do you see the evolution of the U.S. dollar against these currencies?
Sorry, could you repeat the question in English?
Yeah, maybe Jordan is not listening very well from now, but let's continue with Paola, and we'll be just in a few minutes with Jordan. Paola, I don't know if you can hear me, but I will also like to talk about the investment flows. I don't know if you could tell us, maybe from the point of view of the IAF, how investment flows are performing between regions, maybe from emerging markets. Where are going the money? Where is going the money? Where are the inflows and where are the outflows in the world right now?
Our high frequency tracking of non-resident flows to to emerging markets reflects this, with non-China flows now as negative as during the 2013 taper tantrum and the 2015 RMB devaluation scare. The continued volatility in equity markets has hurt the outlook considerably. The situation in China is radically different. Our tracker points there to the largest quarterly outflows on record. There have been a few bright spots, mostly coming from emerging market, excluding China debt, and this has been driven mainly by local currency debt. But unlike earlier in the year, also the appetite for local currency bonds across the EM complex has weakened. So this is contributing to the weaker outlook. In our latest report, we saw in August that there was kind of a halt to the record-breaking outflow episode that started in emerging markets some months ago. August figures were marked by a buoyancy in the equity flows. However, portfolio outflows from emerging markets have picked up in recent weeks, and they have been undoing roughly half of the inflows that we saw in the second half of July and August. Regionally, we see some marginal inflows in Latin America and emerging Europe in the latest data corresponding to September, but outflows from all other regions. Several emerging markets continue to see non-resident outflows from local currency government bonds. This includes Indonesia, Mexico, Brazil, Peru, Chile, Russia, Turkey. For most of these countries, there are, of course, some outliers. For most of them, current account deficits remain manageable, and that's going to help cushion the hit from the weak flows. The constant, nevertheless, in all this has been the weakness in China flows, which have suffered an important setback since earlier in the year.
Thank you, Paula. I think Jordan can hear me now. Jordan, I would like to know, maybe from J.P. Morgan Asset Management.
Are you there, Germán?
Yeah, are you hear me? Do you listen to me? Are you hear me? Jordan, do you hear me? I guess we're having some technical troubles, but well, let me just repeat the question and just fix it. But Jordan, can you hear me right now? Well, let's wait just a few minutes. But what we've seen between this volatility around the world is that some flows from emerging markets have been going to the US, and maybe we have seen some outflows in this context of high volatility around the world. So this has taken the US dollar, and especially or specifically the DXY index to a high level, to a maximum of the last 2 decades. So in this context of high volatility, maybe the US dollar is going to be strong in general terms against all the currencies around the world. So we're talking about these flows, and we are going to talk about the investment opportunities that that the market maybe is seeing in this context of volatility. So, Jordan, I would like to know if you're hearing me right now, maybe.
Yes, I can hear you.
Okay. Sorry for that technical issue, but I would like to ask you about the investment flows. You from J.P. Morgan Asset Management, how are you seeing the investment flows? Where are the inflows and the outflows around the world at this moment?
Yeah, sure. It seems to be quite clear to us that the dollar remains paramount, and you're seeing sort of a again continued appetite for dollar-based assets, which has contributed to the big rise in the value of the dollar that we've talked about a lot here on this call. I will say, as we look at flows, as was highlighted towards emerging markets, it's been somewhat of a mixed bag. I would say EM economies in general have seen outflows on net year to date, but your more commodity sensitive countries that have actually benefited from the rise in commodity prices have seen sort of less of those outflows, where you have other economies that may have more meaningful current account deficits, for an example, really coming under pressure given the outlook of a weaker global economic backdrop. And so we're seeing a lot of varying again in terms of investment flows across regions. Again, it was highlighted. I want to sort of reiterate a lot of the very, very strong points that Paola made in terms of which countries are seeing flows. We look at the very similar data in terms of capital flows that's generated from the IIF. So I won't reiterate a lot of those points being made. But as we think about the outlook, we are sort of more constructive on those from an investment perspective. We're more constructive on those economies that may be more tailored towards a rebound in growth coming out of the Asia region, and also those economies that may be a bit more closed off than some of their other counterparts. So in particular, we think some opportunities still remain in areas like Brazil, Indonesia, India, as well as Chile. But we are still seeing some challenges in places like Mexico. So those are, generally speaking, at a high level, how we're sort of seeing the landscape. We're still very much in the camp that the dollar remains strong through the end of the year. We think as we move towards the first quarter of next year and into the second quarter of 2023, we could be entering the early innings of finally some dollar weakness. But we would like to see more signs that China is coming back online, signs that Europe is able to weather the energy crisis, not just through this upcoming winter, but particularly through the winter of 2023. And then again, I think that's when we're finally starting to see flows really begin to revert back. And I think that's also going to be a time where you'll start to see that DM growth alpha begin to reassert itself, and we tend to see flows begin to pick back up in a positive direction when you start to see that EM alpha begin to again move higher quicker than we would out of the developed markets. And we think that the alpha begins to again reassert itself in the first half of next year.
Thank you. Before talking about investment opportunities, I would like to ask Paola about some structural changes that I've seen. First, we are in a context of high level debt in high global debt levels. And also we have seen the Federal Reserve talking about the intention to take the interest rate to 4.5 or close to 4.75% the next year. But we also, between this high volatility around the world, we have seen that other currencies like Australian dollar, Canadian dollar, renminbi are gaining some relevance in the reserve currency basket around the world. Maybe those currencies that I mentioned get to the 10% of the global basket. So what do you think about the role of the US dollar, and how do you see it in the long term, and also incorporating in your answer maybe that condition of high debt levels in around the world, and an interest rate that is going to go to the 4.5 or 4.6% in US?
Mhm. Yes, thanks, Germán. So yeah, there was a strong debate around this maybe a couple of years ago. Markets were debating whether the dollar was entering a secular decline. There were also mounting questions around the reserve currency status of the greenback. Sentiment was very negative at the time, given large U.S. Budget deficits that were heavily financed by Fed QE purchases of Treasury securities. So at the time, a substantial dollar short position had built up in foreign exchange markets. We are currently quite seeing a picture that is completely the opposite. So questions about the strength of the dollar as a reserve currency status have been put a little bit on the back burner for now. But that said, yes, there are repeated references to the dollar dominance. The share of dollars in global identified foreign exchange reserves has been trending downward, as you say, for 20 years, from a bit over 70% at the turn of the century to just under 60% of allocated reserves at the end of the first quarter of 2022, according to IMF data. China's renminbi, for example, however, still accounts for a very small share, around 3%. So as IMF put out a paper at the time, there are signs that central banks are looking to diversify away from the US currency. 3/4 of the moves have been into currencies of smaller economies, including Canada, Australia, South Korea, Singapore, that were called non-traditional currencies. And this is reflected a number of issues, markets becoming more liquid, more available electronic trading platforms that reduce costs, central bank, the increasing size of central bank reserve portfolios, etc. More recently, we're back to this debate, and in partly it's motivated by the sanctions imposed on Russia. And so we think that the push to accelerate the diversification towards other currencies is still there. Now, quickly, what about diversification towards the renminbi? So as I was mentioning before, we've been looking at flows into China and we have done this in the lens of renminbi internationalization, and allocation of central bank reserves to Chinese bonds. Non-resident flows to Chinese local currency government bonds attracted attention in 2020 and 2021 in the context of the index inclusion of China, and this was one step by the government to to open financial markets. At this time, this was quite remarkable. Non-resident holdings of local government bonds rose 50%, which was a very high figure in a time of not only COVID, but also a very low risk appetite in markets. So what we find in the last few years is that about a third of the flows that have been going to Chinese bonds were due to reserve accumulation. This is similar to the UK, but this is lower than other countries. And even though flows to China have picked up, the country is still not at a stage of financial openness that is comparable to more established reserve currency issuers. Global yuan holdings are small relative to the Chinese economy and also relative to China's international trade. So out of this, the corollary is that the renminbi still seems far from a top global reserve asset. Now, given the size of China and the still limited role of foreigners in its local markets, we do see that there's a role for a higher participation of yuan in foreign bond holdings. I think those will generally grow. However, we do think that the tense and complex U.S.-China relationship and the more recent geopolitical developments around Ukraine could possibly be detracting from that appetite for the China government bond.
Thank you, Jordan. What is your opinion on that side?
Yeah, sure. So when we look at sort of the opportunity set across global bonds, and particularly across emerging markets, we find, and this is very much given a baseline case, that we have a softish landing here in the U.S. economy, as well as inflation that's going to show clear signs of receding. We think there is a very real opportunity set that's bubbling up, given the yield levels that we're seeing on global bond aggregates. And so, for an example, our outlook is, again, given this softish landing of economic environment in the U.S. as well as moderating inflation, looking at something like the J.P. Morgan Global Bond Index. This is a dollar-denominated index. We think at current levels, over the next 12 months, we could be seeing returns to the tune of around 16%. And then on a hard currency perspective, some more modest returns of around 13% over the next 12 months. And so we do think that, again, given this big move and shift that we've seen in global developments, and really the move that we've seen in yields across a lot of these emerging market indices, is certainly creating a really, really interesting opportunity set. But it is very much based on the idea that inflation will begin to come down. The U.S. recession is a relatively mild one, and that the big winners will be your higher real yielding currencies and asset classes in this environment, particularly relative to the Federal Reserve. On the initial question about the dollar's reserve status more broadly in the context of history, it's been interesting since the euro was introduced in the late 90s. The dollar has fallen from roughly 71% of FX reserves down to just shy of 60%, so around 59% of FX reserves. And I think what's really important is that this trend in the dollar being a prominent reserve currency is likely a very, very long trend. I think we're going to continue to see economies looking to diversify their reserve holdings across a broad basket of different currencies. But I think this is going to be a very long-term shift. The reality is the dollar is still viewed as a safe haven asset. That's one of the reasons why the dollar has continued to be elevated, and we've seen even developed market economies by way of the Bank of Japan, for an example, which hasn't had to intervene in its foreign currency markets over the last 20 years, having to intervene selling dollars to buy yen to try to prop up their the value of their currency. And so, I do think the dollar will continue to sort of garner a smaller share, but this will be a very long-term trend. I mean, we're talking over, call it the next 20 to 30 years, that this smaller share will continue. It's very difficult when global trade is still conducted in dollars. But what I will acknowledge is that we continue to show signs that U.S. growth is slowing, and there's going to continue to be much stronger growth over the long term in other parts of the world, which certainly suggests that other currencies will have their time in the sun. It'll just take a long time for us to get there.
Perfect. Before talking about investment opportunities and financial market outlook, I would like to ask you both to take one side. What do you think the 2023 will be in terms of US dollar? Lower US dollar from the actual level, the current level, or a higher US dollar? Maybe Paola, if you. Go ahead.
We can leave him start.
I was just going to say, by the end of 2023, I think the dollar will be lower than where it is today.
And you, Paola?
Yeah, I do think it will be lower, and especially we are in the camp in which we think that the Fed interest rate hikes have gotten a bit too far. We think that based on our on our growth forecasts, there's a high risk of recession in the U.S. and this definitely is going to lead to possibly a pivot in the Fed fund hikes in the near term that maybe is being discounted. However, we continue to see the issue of the weakness in the euro, which is also boosting the dollar or accelerating the weakness of those currencies against the dollar, and that is a more complex situation that is very much dependent on very uncertain factors, as we are seeing, and it's highly a result of the energy price shock due to the war in Ukraine. So a lot of volatility will continue to come out of there.
Thank you. Jordan, I would like to ask you some questions on the investment opportunities side and outlook. And you also talk about interest rates, maybe the higher interest rates around the world. And actually, in Colombia or in Latin America, we've seen central bank rates reaching levels only comparable to the 2000 levels or the end of the 90s in terms of interest rates. And also, when I see, for example, the fixed income market, and I look at the global, Bloomberg Barclays Global Aggregate Index, I see that the annual change in the yield level has been one of the highest since the mid 90s. So, do you think in the fixed income market specifically, there is a once in a decade investment opportunity, or how do you see it from JP Morgan Asset Management?
Definitely. I think there is a massive opportunity. When you just take a step back, we've gone from a world of $18 trillion in negative yielding debt to sub $3 trillion in negative yielding debt. And as you've mentioned, we're seeing some of the highest yield levels really across the board in over a decade. Now, we're still in an environment in which the majority of central banks are still increasing interest rates, both on the developed market side, with the exception of the Bank of Japan and the Bank of China, as well as on the emerging market side as well. But I would argue probably the biggest difference is I think emerging market central banks, as well as the Federal Reserve, are probably closer to the end of their rate hiking cycle than they are towards the beginning. And so we're seeing some clear signs that inflation may be peaking out in Latin America. In the aggregate, inflation is still running at around it's just slightly north of around 8%. But we do feel confident that sort of that inflation may have peaked over the last couple of months. And so with that backdrop, and again, under the notion that the U.S. may experience a recession, albeit a modest one sometime next year, our base case is for inflation to continue to come down. And maybe central banks, particularly the Fed and certain central banks across Latin America, maybe not have to be as aggressive in continuing to increase interest rates. And in that environment, you now have yields at some of their highest levels that they've been in more than a decade, and it's simple bond math, right? So if the current yield level that you're able to get is a pretty good indication of what your total return profile will look like over the next 5 to 7 years. We feel pretty confident that while certain pockets of Latin America might struggle, others may be able to weather the storm a bit better. And in fact, if we're talking about a European recession, we're talking about a recession in the U.S., that emerging market to developed market growth alpha is going to begin to favor emerging markets over the course of 2023. I think that leads to positive inflows to sectors that have been pretty hard hit. And again, as I mentioned in my last response, if you were to look at our base case for that softish landing and inflation to come down in the U.S., we could see emerging market debt, dollar-based indices that deliver roughly 13% total returns over the next 10%, while local currency sovereign debt delivering roughly 13% over the next 12 months. And so I think this is a really great opportunity to begin putting some money to work. The challenge is right, making sure we're allocating towards those economies that we feel are going to be a bit more resilient through a broader global slowdown in growth over the course of next year. These are economies that have much smaller current account deficits, economies that have a smaller percentage of their dollar-based debt denominated in dollars. And so if you look at a country like Argentina, for an example, still north of 50% of their government debt is denominated in USD. If you look at a country like Colombia, for an example, still north of 30% of their debt is denominated in dollars. And so if we're still talking about an environment of dollar strength, those countries may come under pressure. But other countries that have sort of low levels, you think of countries like Brazil, for an example, we think may be able to hold up a bit better in that environment.
Okay, I've received some questions regarding the Credit Suisse situation, some news about the European financial system that we heard this week, and we've seen in the financial markets with the credit default swaps going up and all the volatility regarding the situation on Credit Suisse and Deutsche Bank. And I would like to connect this part or these questions with this part of the fixed income market, because we've talked about the high interest rates, what that environment represents in this high debt levels environment around the world, and that translates in higher credit risk for the economy. So how do you see the Credit Suisse situation, and how do you see or maybe do you see any possibility of crisis or systemic risk arising from the from the European financial system? Maybe Paola, and then Jordan, if you like.
Maybe Jordan can answer this question. Yeah.
Okay, Jordan.
Yeah, sure. So we don't think that the Credit Suisse situation is a Lehman crisis. When we sort of take a look at the bank's overall balance sheet, we actually still find that we think Credit Suisse does have ample liquidity. They're sitting at about 160 billion worth of Swiss franc. They have roughly about another north of 100 billion in interbank assets. And so, we actually do think they're in a decent liquidity position. But we've seen their credit default swap rates really shoot higher under the expectation that they'll come under significant pressure. It's interesting. You've already seen Credit Suisse's equity up about 20% already so far on the week, and I think markets are sort of sniffing out that this isn't in fact a Lehman moment, but a much more concentrated. But to the point that you've highlighted earlier, it ends up boiling down to contagion, right? And how bad, if we start to see a certain level of losses, while there may be able a certain percentage be able to be recovered, what's the contagion risk? And certainly within Central Europe and broader periphery, there is contagion there, and that could bring things under pressure, particularly given the interest rate environment that you just outlined. But I think to a certain extent that this could potentially be an opportunity. Again, we don't think that this is a Lehman moment, but we do recognize that this is certainly adding another layer of volatility to European corporates.
I will also like to talk about equity, but our annual report this year is titled "New Challenges, New Opportunities," and is also because we recognize that the high levels of interest rates are creating huge opportunities in the fixed income market or the fixed income investments, but is also creating very huge challenges for the macroeconomic outlook, for the household consumptions, for finding capital, for the increasing cost of the capital around the world. So I would like to talk or ask Paola about the macroeconomic outlook. You from the IAF, how do you see the global economic outlook? Maybe if you could share with us your thoughts in detail about the U.S. economy, taking into account that, for example, Jordan talk about a softish deceleration or something like that. So how do you see from the IAF the global economic outlook for 2023?
Yeah, sure. So we had the broad outlook is that we had in May a call for a global recession already at that time following the invasion of Ukraine by Russia. We unveiled then a forecast which saw global growth becoming flat. We had for the US a growth forecast of 2.5%. For China, we had a below consensus forecast at the time of 3.5% and 1% for the Eurozone in 2022. So with the assumptions that we made for emerging markets, we had a global growth forecast of 2.5%, which ended up being exactly the statistical carryover for the global economy. And this meant that what we denominate true growth, adjusting for that statistical carryover, it was already going to be flat back then. So we were basically forecasting a scenario in which global growth was flatlining globally, and the threshold for a recession was already very low. Since then, we have seen US growth come in quite a bit weaker. We are tracking annual average growth in the US of an annual average basis of 1.6%, and this implies that Q4 over Q4 year-over-year growth rate of 0.2%. So essentially, the US growth is flatlining in part because of monetary tightening, which is weighing on housing. Then looking further, we have China that is looking much weaker than we already had seen in our below consensus forecast. We are now tracking a growth rate of around 2.6% this year, which looks equally weak. There are multiple headwinds, the fact that there is no quick end to COVID zero policies to boost consumption, no large-scale policy easing, all that will make for a very weak H2 in China. Consensus is still above 3%, but we have recently lowered our forecast for 2.6%. And next year, everything will depend on how consumption and whether consumption rebounds in China. This will be crucial for growth in 2023. We have a range between 4.3 and 5.5%, depending on when this consumption restarts. And given this, our central scenario is 4.5% growth, or even less than that. And then in the Eurozone, we have seen very bad indicators recently. For example, the European Commission measure of consumer confidence fell in September to minus 28.8. That's below the previous trough of minus 26.9 in November 2012, which was at the height of the Eurozone debt crisis, and it was also far below the COVID low of minus 22.7 in April 2020. So the Eurozone did at the beginning of the year, though, have upside surprises to GDP, which actually put the statistical carryover for the second part of the year at around 3%. We are now forecasting 1.7%, which means that Q3 is now going to be close to zero. And in Q4, we are actually penciling in quite a sizable contraction of about 1.5% quarter over quarter. This in general means for the Eurozone that the economic picture for next year is going to be quite challenging, and we are forecasting a GDP fall on an average annual basis of around 2% next year.
Thank you, Paola. And Jordan, I would like to ask you this last question, and regarding this macroeconomic outlook, how do you see risk assets? How do you see equity? How would you recommend an investor to position his portfolio in the equity side and in US and globally?
Sure. I think it's important first, as investors think about how to position, I think it's important to think about the timeline. Is this a 1-year position? Is this a 5-year position? Because there are two probably very, very different answers. So initially, markets, equity markets in particular, tend to bottom well before a recession actually happens, both here in the US and globally as well. And so to a certain degree, I think over the short term, we may actually be in an environment in which bad news equals good news. And what I mean by that is if we start seeing, I think, generally speaking, across the street, many economists, their base case for the US is for a recession in 2023. Now, I still think that the question of a global recession remains still up in the air. It will certainly matter about the depth of the US recession and potentially how Europe emerges from this energy crisis, as well as if China can actually orchestrate their economy coming back online sometime in 2023. But if we start to see clear signs that the global economy is slowing down, that would suggest that central banks don't need to be as aggressive as they're signaling. I mean, you think about the Bank of England, for an example, just given the inflation dynamic there, they're expected to lift rates to north of 4% in the Bank of England. The ECB is expected to lift rates to roughly 2 to 2.5%. And if we start seeing clear signs that the aggregate demand, the global economy is slowing, that will bring down inflation. And so a broader slowdown will help to alleviate some of the inflation pressures that a lot of global central banks are very focused on trying to deal with today. And so I do think over the short term, if we start to see clear signs of the broader economy slowing, that means central banks can pull back on that hawkishness, and you actually may get a rally in risk assets. Now, again, this is very well signs that risk assets are anticipating, recognizing that in risk assets, a lot of that weakness has already been priced in. It's been remarkable. Markets have really struggled to keep up, particularly keep up with the U.S. market coming out of the pandemic. Typically, we tend to see markets performing pretty strongly. You tend to see sort of bubbles forming in either the real economy or in financial markets. But valuations are pretty attractive, particularly even more so in international assets versus assets in the U.S. And so when we look at sort of the short-term outlook, we think it's going to be choppy. We think it's going to be particularly difficult. Again, given a lot of the challenges that we outlined from a global standpoint, we also think the dollar is going to remain strong, which is also going to continue to act as a bit of a tailwind over the short term. But as we look over the longer term, we actually like international assets more than we like U.S. assets. Again, this is looking at it from a 5-year standpoint. If you were to look at just relative valuations, international markets are trading at a roughly 30% discount relative to the U.S. They provide roughly 2 percentage points more in dividend income relative to the U.S. And generally speaking, whereas the Federal Reserve has really removed all of its stimulus, again, by way of reducing the size of its balance sheet, but also raising interest rates. I think the environment may look, when things all shake out, maybe still slightly a bit more accommodative for international markets. And so, over the next 5-year period, we would have an overweight to international relative to U.S. Equities. I also think, just given the meaningful move higher that we've seen in yields across the board, a global 60-40 portfolio is not dead. It actually is probably going to provide particularly strong returns, similar to what we saw, particularly at least here in the U.S. over the last expansion prior to the pandemic. And so, I think over the longer term, international there's an overweight to international versus the U.S. on the equity side. Then I think on the bond side, I think a global bond portfolio is going to deliver very strong returns, still with sort of an emphasis to the U.S. And that's based off the notion that U.S. rates are high. We think they're going to end. Real yields are going to end in the neighborhood of around 2%. And so in that environment, we do think if a recession were to materialize, you will see a more meaningful come down in yields, particularly in duration, providing very strong returns. But again, we're seeing a lot more opportunities bubbling up on a global scale also.
Thank you, Jordan. And I would like to thank you both. Thank you, Paola and Jordan, for being with us, for sharing your thoughts and your views on the US dollar, on the financial markets. Thank you. Thank you again.
Thank you.
Bye.